Welcome to the Pro Ticker Deep Dive.
hmm
So if we were to kind of give the last few years a personality, they've been pretty erratic, haven't they?
Oh, definitely. I mean, think about it.
Yeah, 2021 was just pure unchecked euphoria.
Totally. And then 2022, that was just pain, inflation, the big adjustment.
Painful is the word. And then 2023 was, well, surprising resilience, actually.
Exactly. Which brings us to now.
Right. As we move into this next phase, I think investors are asking, what's the mood now? Are we, finally getting into clearer waters? Or are we just sort of catching our breath before the next storm hits?
Yeah, that's the big question. And the sources we're looking at, they're pretty clear that the whole investing mindset has fundamentally shifted.
You have to how?
Well, we're moving away from that defensive survival mode, the one that really dominated during the rate hike cycle.
Right, when everyone was just trying not to lose money.
Precisely. And we're moving toward, let's call it measured opportunity. The story isn't about some sudden roaring bull market charging ahead. It's more like a slow, steady advance. You could maybe call it the grind forward.
The grind forward. I like that. So navigable, but not easy.
Exactly. The environment today is definitely more navigable than it has been in years, but that navigability, it requires serious discipline and selectivity.
Yeah.
Especially for you, the listener.
Yeah.
The market now is rewarding very specific, credible growth stories. It's not about broad bets anymore.
Got it. Okay, let's unpack this new reality then. You mentioned this grind forward macro environment. It seems to be defined by, what, 3 big overlapping themes?
That's right. 3 main things shaping the cycle right now. First, you've got growth that's slowing down, but it's also proving pretty persistent, resilient.
Okay.
Second, inflation. It's cooling off, sure, but it's also staying kind of stubborn. Sticky.
Right. Still hanging around.
And third, you have the central banks. They're being cautious, yes, but also quite deliberate in their actions.
All right, let's start with that first one, growth, the economic engine. Why is the U.S. consumer, in particular, still defying gravity? Rates are high.
It's a really good question, and it comes down to these unexpected structural offsets. I mean, yes, housing is feeling the pressure. Discretionary retail, too, those are facing headwinds.
Sure.
But corporate investment, tied to these big, long-term secular trends, that's providing an incredible floor under the economy.
What kind of trends are we talking about?
We're talking massive, multi-year spending cycles. Think infrastructure projects, the whole domestic energy transition, reshoring global supply chains.
Oh, okay. So big structural stuff.
Exactly. Plus, wages are still pretty resilient, even though the pace of growth is easing a bit. So you put that combination together, and the U.S. economy, well, it remains the anchor of global stability, really.
And that stability here really highlights the complexity everywhere else when you look globally, doesn't it?
It really does. Europe, for instance, seems to be stabilizing after that massive energy shock. We're seeing some tentative improvements, maybe in Germany and France.
But the UK.
The UK is still lagging a bit. They've got some structural fiscal constraints holding them back.
Okay. And Asia. Sounds like a mixed bag there.
Asia is where the real nuance is. Japan, surprisingly, has some real momentum, partly driven by corporate governance reforms, partly because inflation is finally back.
Interesting.
India is still, the shining engine, strong demographics, strong capital inflows pouring in.
Right.
But China is the major wild card. I mean, sure, short-term stimulus helps things along a little,
Right.
but they are wrestling with these huge long-term structural issues, severe demographic decline, crippling debt, especially in the property sector. Their path really dictates so much of the global growth story.
Okay, so if growth, especially in the U.S., is still pretty resilient, that means the Fed and other central banks, they can't relax just yet, can they?
Not at all.
Which leads us nicely to that second theme, inflation. You said cooling but sticky. Headline inflation looks much better, right? Cheaper energy. Supply chains are basically normal now. So what's the actual problem?
Well, the problem is the stickiness of core inflation.
Okay, the underlying stuff.
Exactly. The stuff that doesn't include food and energy. You can't fight that just by, opening up ports faster. The easy part of the inflation fight, that was goods, inflation. That's pretty much over.
So what's left?
What remains is service sector inflation. And that's fundamentally driven by things like the cost of labor, healthcare costs, and crucially, housing rents.
And those things move slowly.
Very slowly. They adjust really gradually. They just lack those rapid feedback loops you see with commodity prices, for example.
Right.
And because labor costs and rents are sticky like this, central banks know they need more than just 1 or 2 soft data reports to, declare victory.
They can't risk jumping the gun.
Precisely. If they rushed the decision, they could easily reignite those service-driven prices, and that would cost them all their credibility they fought so hard to regain.
Which brings us neatly to theme number 3, the central banks themselves. This constant dance they're doing. They've been incredibly clear, haven't they? Policy is restrictive, and it's going to stay restrictive for longer than traders want.
Absolutely. Rate cuts are definitely on the horizon, we think. But the message is, they will be slow, and they will be measured.
And that creates tension, doesn't it?
Oh, yeah. What's fascinating here is that tension. You've got the market, which is pricing in, or at least hoping for, much more aggressive easing. Traders want the old low-rate environment back, like yesterday.
Of course.
But the central banks, their priority now is stability and protecting their hard-won credibility. They seem willing to tolerate slower growth for a while to make absolutely sure inflation is truly beaten.
So they're digging their heels a bit.
They are. And this clash, this difference between market expectations and the likely policy reality, that's exactly why we're still seeing elevated volatility, especially in bonds and currencies. It's basically a battle of patience.
Okay, that sets the macro scene really well. So now let's translate that grind forward environment into specific asset classes. This is where you said selectivity becomes like an actual requirement, not just a buzzword.
That's it.
So what does this mean for equities? Stocks?
Well, the character of the U.S.-led equity rally, it's changing. We've definitely seen the dominance of mega-cap tech, AI, cloud, semiconductors. That narrative is certainly still there. It continues.
Right.
But here's where it gets really interesting. We are seeing rotation happening under the surface. Money is quietly shifting into cyclicals.
Which ones specifically?
Specifically things like industrials, financials, and select energy names. Now, why those? Because these are the companies that directly benefit from all that infrastructure and energy transition spending we talked about earlier.
Ah, the stuff providing that macro growth floor.
Exactly. It's connecting the macro resilience to specific sectors.
Okay, but what about valuations? That's always the worry, especially in tech. Are we looking at bubble territory?
Broadly, probably not. Mega-cap tech valuations are stretched, let's be clear. There's no doubt about that. But if you look at the broader S&P 500 index, it's trading at a premium to its historical average, sure, but not some astronomical bubble-like premium. It actually shows a degree of rational pricing, perhaps reflecting the resilience of U.S. earnings we discussed.
So expensive, but not crazy overall.
Kind of, but, and this is the crucial point for you, the listener, this means investors must be ruthlessly selective. If a company doesn't deliver credible quality growth, and if it doesn't maintain a strong balance sheet, it will likely get punished. Severely.
Okay. Ruthless selectivity. Got it. Let's pivot now to the asset class that, it suffered the most over the last couple of years, but now it seems to be quietly demanding attention.
Ah, you mean bonds.
Yes. After 2 really brutal years, I think I'm ready to officially declare it. Bonds are back. Fixed income is investable again, isn't it? Offering attractive income potential.
It really is a generational shift for fixed income. I mean, think about it. For the first time in maybe a decade, you can actually lock in substantial yields without having to take on excessive credit risk.
So safer bonds are actually paying something decent now.
Exactly. Investment-grade credit, in particular, offers really appealing income opportunities right now. And that transforms fixed income, doesn't it? It goes from just being portfolio insurance, something you hold in case of a crash,
Right.
to being a genuine income generator for your portfolio. It's a huge change in its role.
And what about the treasury curve? That's always a big signal.
Right. Well, if you look at the treasury curve, it does remain inverted, meaning short-term rates are still higher than long-term rates.
Which historically signals slower growth ahead, right?
Typically, yes.
Yeah.
But the degree of that inversion is narrowing. It's becoming less inverted. And that narrowing, that's like a quiet signal, maybe, of growing market confidence, albeit slow confidence, in that soft landing narrative.
So still cautious, but maybe a little less pessimistic.
Something like that. The overall structure of the fixed income market is definitely improving.
Okay, good. Moving on to commodities. There seems to be a bit of a split personality here. Oil, for example, seems kind of range-bound, stuck between, say, $75 and $85 a barrel.
Yeah, it really is.
What's pulling in both directions like that?
It's this constant tension. On one side, you have OPEC plus maintaining supply discipline, trying to keep a floor under the price.
Okay, the supply side.
Right. But on the other side, you've got this persistent softness in Chinese demand, plus rising global inventories. And that acts as a ceiling on the price. It's just a very tight balancing act for crude oil right now.
Okay, so oil is balanced, but contrast that with metals, specifically what people are calling the green metals.
Ah, yes. Copper, nickel, lithium. These are the core components for electrification, and they are benefiting from arguably the strongest structural demand drivers in the entire global economy right now.
Like what?
Things like EV adoption, modernizing the electric grid, building out renewable energy capacity.
Stuff that have to happen.
Exactly. What's crucial here is that the demand isn't really flexible. A lot of it is driven by government policy mandates around the world. But the supply, that is constrained.
It's harder to get out of the ground.
Much harder. Opening new mines takes decades. It's often politically difficult.
Yeah.
So you have this constrained supply meeting relatively inflexible rising demand that creates really powerful long-term bullish conditions, and it's attracting serious long-term capital.
Makes sense. And what about gold? Often forgotten.
Yeah, don't forget gold. It's actually been a quiet winner recently. It's regaining its appeal as a really crucial portfolio diversifier, especially as real yields, that's interest rates minus inflation, start to stabilize.
And maybe geopolitical uncertainty helps too.
Definitely. Lingering uncertainty, geopolitical risks bubbling away in places like the Middle East, Eastern Europe, that always helps gold's appeal as a safe haven.
Okay. And finally, let's touch on currencies. The U.S. dollar is still the heavyweight champ, isn't it?
Mhm.
But the landscape seems to be getting more interesting, more tactical.
Absolutely. The dollar remains king for now. But the euro, for example, is finding a bit more support as European economies stabilize, like we mentioned.
Okay.
And we're watching the Japanese yen very closely. The Bank of Japan seems to be edging ever so slowly towards policy normalization after years and years of ultra-low, even negative rates.
Which could be a big deal.
It could create the potential for significant policy-driven shifts in the yen. So for tactical investors, people making shorter-term bets, the dollar's trajectory is really everything right now. Its strength or weakness basically dictates global capital flows, especially money moving into and out of emerging markets.
Okay, this distillation is great. It really brings us to the payoff for the listener. What are the key opportunities to actually engage with, and what are the critical risks you really have to hedge against in this grind-forward world?
Exactly.
Let's start with the positive side, the four measured opportunities you see.
Okay, number one, the Industrial Renaissance.
Mm.
This is that multi-year, multi-trillion-dollar investment boom we talked about.
Yeah.
Reshoring supply chains, upgrading infrastructure.
Right.
So for you, this means looking at areas like construction engineering firms, specialized machinery companies, maybe even defense company sectors benefiting directly from reliable, often government-backed spending programs.
Okay, industrial renaissance. What's number two?
Secondly, perhaps the most accessible opportunity right now, bond income.
We touched on this. Bonds are back.
They really are. This is that once-in-a-generation reset for fixed income.
Yeah.
You can build steady cash flow portfolios using quality investment-grade credit. It fundamentally changes how you can generate income from your capital.
Makes sense. Opportunity three.
Third is green metals. Again, we discussed the drivers. This isn't just a cyclical trade. It feels more like a structural necessity.
Driven by policy and electrification.
Right. So you look for companies exposed to copper, nickel, lithium, where those deep supply constraints are meeting that relentless demand growth.
Got it. And number four.
Fourth is selective emerging markets. And the key word here is selective. We aren't talking about broad exposure across all emerging markets.
Too risky.
Can be. Instead, we're targeting specific regions. Ones with strong commodity bases, sure, but also, crucially, credible and disciplined monetary policies. Think places like Brazil, maybe Mexico, India.
Okay, so selective EM. Now, let's flip the coin. The long shadows, the risks we need to watch out for.
All right, the risks. Number one, the biggest threat, I think, is sticky inflation just persisting. If that core inflation doesn't break decisively lower,
Then what?
then central banks will hold rates higher for much, much longer than the market currently expects. And that's the scenario that immediately kills the soft landing dream. It likely triggers a recession.
Okay, sticky inflation is risk number one. What's next?
Secondly, pretty obviously, geopolitical shocks, whether it's a sudden escalation in Ukraine or the Middle East flaring up again, or maybe unexpected outcomes from a major global election cycle. These are constant, unpredictable flashpoints.
And they can cause sudden market drops.
Exactly. Sudden risk-off moves that are hard to predict or hedge.
Okay. Risk number three.
The third major risk is valuation traps. Now, yes, mega-cap tech is obviously exposed if growth slows down significantly. We know that.
Right.
But perhaps surprisingly, you also need to be careful with some defensive consumer staple stocks right now.
Really? The safe stuff.
Paradoxically, yes. Some of these traditionally safe stocks look extremely expensive relative to their pretty sluggish growth potential. That makes them potentially a poor value proposition at the moment, a valuation trap.
Interesting. Okay, and the final risk.
And finally, there's always the risk of policy error. Central banks, as we said, are walking the finest of tightropes right now.
Trying to balance inflation and growth.
Exactly. If they over-tighten, they could easily cause a deeper global recession than necessary. But if they ease too soon, before inflation is truly dead, they risk reigniting it and losing all their credibility.
So a misstep either way is bad.
A misstep in either direction likely triggers a sharp, painful market repricing that you really need to be prepared for.
Wow. Okay, so that lays out the opportunities and risks clearly. And the technical view from the market charts, does that confirm this cautious grind forward outlook?
It really does. The technical picture adds a layer of caution. While overall markets, like the S&P 500, are moving higher, the breadth of the rally, that's the number of individual stocks participating, is actually narrowing.
Meaning fewer stocks are doing the heavy lifting.
Precisely. Fewer and fewer stocks are driving the index higher. And that makes the broader market, like the S&P 500, more vulnerable to quick corrections if those leaders stumble. This is not a broad, healthy advance across the board. It's becoming a highly concentrated one.
Okay, that technical warning definitely fits the overall theme.
Yeah, I think it really summarizes the overall mandate for you, the listener, right now. We are not sprinting ahead in a euphoric bull run.
Definitely not 2021 again.
No. But we're also not collapsing into some sort of 2022-style abyss. We are, as we said, grinding forward.
A grind forward.
Yes. And this is a market environment that really rewards patience, balance, and above all, ruthless discipline in your selections. It is definitely not a market for the gambler.
So the final word then, the core instruction, the mandate for listeners is?
It's pretty simple, actually. Don't chase the hot stocks, but absolutely do not hide in cash either.
Be engaged, but be smart about it.
Exactly. You have to build diversified portfolios. Combine quality equities, those with strong balance sheets and credible growth, with selective bonds for that newly available income. And then add strategic exposure to those big long-term structural themes we identified, like electrification and infrastructure.
Balance and diversification are key.
They are, but given that technical warning we just heard about the narrowing breadth, that reliance on fewer stocks driving the whole market rally.
Yeah.
Well, maybe the provocative thought for you, the listener, is to consider how that narrowing breadth fundamentally changes the definition of portfolio diversification in this current slowly but surely environment.
Meaning just buying an index might not be diverse enough anymore.
Perhaps. Simply owning an index might not offer the same kind of protection, or maybe even the return characteristics that it once did when the rally was broader. Something to think about.
Definitely something to mull over.
Yeah.
Okay, great insights as always. See you all in the next Pro Ticker Deep Dive.